Hey everyone, welcome back to Corporate Decoder, the place where we break down the confusing world of finance using plain English. And I've got a doozy for you today, something that is a bit of a puzzle box with financial surprises, and some really interesting risks Davion Healthcare PLC is heading towards a direct listing on the NASDAQ, but will it be smooth sailing or a bump? You're right, let's find out before we dive into the nitty gritty. If you appreciate getting straight insights from these dense corporate filings, make sure you are subscribed. We also have a Discord community linked in the description below where we break down even more financial news and discuss it together. So Davion Healthcare is getting ready to list on the NASDAQ, and this filing is an update to their registration statement. They're not selling new shares to the public right now. Instead, existing shareholders are looking to sell their shares. This is called a direct listing, and it is a bit different from your usual stock market debut. Think less big. Flashy IPO with underwriters setting the price, and more of a direct exchange where existing owners can start selling right away. The main point of this amendment is to add more detailed information about how this direct listing will actually work, including how the opening price will be decided and what the plans are for selling the shares. They are not asking for the registration statement to become effective right now. They just want the SEEK staff to take another look at the new disclosures. Davion Healthcare believes they are meeting all the requirements to get listed on the NASDAQ. This includes having enough shares available for public trading, enough shareholders who own those shares, and meeting certain financial value requirements. But remember, NASDAQ has the final say and can change its mind. This is a critical piece for a direct listing. There is no underwriter saying, "We think this stock should be worth $12 a share." Instead, NASDAQ itself will use a special auction system right before trading starts to figure out the opening price based purely on how many people want to buy and how many want to sell. They've used an expected opening price of $12 as a reference for listing requirements, but the actual price could be very different. This really hammers home the difference between a direct listing and a traditional IPO. No new shares are being created by the company, no underwriters are involved to help sell the stock, and there is no structured process to build up demand or support the price. It is all about the open market reacting to the supply of shares from existing owners. A bit about the company itself. They are focused on developing easy-to-use home tests for detecting potential health issues early. Think of it as a first alert system for your health. They have 4 main products developed: BreastCheck, FootFlow, Testic, and Thermoderm. BreastCheck is set to be their first product launched, aiming for the first half of 2026. These aren't diagnostic tests, meaning they don't give a final medical answer, but they signal if further investigation might be needed. These products are approved under the simplest regulatory category for medical devices. Class I, this means they can be sold directly to consumers without a prescription, which is a big plus for their go-to-market strategy. Their business model is to license their technology to other companies. This means Davion focuses on inventing and developing the products while their partners handle making them, selling them, and supporting customers. This can be a capital-efficient way to grow, but it also means they rely heavily on their partners' success. Now for the exciting part, the risks, and for a direct listing, these are especially important. You can expect volatility because there is no underwriter to smooth things out. The opening price might swing wildly. There is no guarantee of how much buy or sell interest there will be, which could affect how easily people can trade the shares. Also, if a lot of existing shareholders decide to sell their shares all at once, it could really drive the price down. This highlights a key difference. In a normal IPO, underwriters help guide the process, manage expectations, and often provide some price support. In a direct listing, that safety net isn't there, potentially leading to more unpredictable trading. Going back to their business model, relying on licensees is a double-edged sword. If these partners don't perform well, if they have financial problems, or if they face regulatory issues, it directly impacts Davion. They have limited control when crucial parts of their business, like manufacturing and sales, are in someone else's hands. An important disclosure here is a material weakness in their internal financial controls. This is a serious issue that means there is a reasonable chance that important financial information might be wrong. They are working to fix this, but it is something investors should be aware of. Let's look at the numbers. This table shows their financial structure. As of the 30th of June 2025, they had very little cash, about 4,396 euros. Most of their financial situation is made up of equity. The total capitalization is over 65 million euros. This is a company that has spent a lot on developing its technology, and that is reflected in their balance sheet. This is interesting. For the year ended the 31st of December 2024, their loss per S-share was about 0.06 euros, but if we look at the pro forma numbers, which adjust for the direct listing, it jumps to 0.12 euros per S-share. This suggests that the costs associated with the listing itself, like paying advisors and issuing shares to them, will significantly increase their losses moving forward. Looking at their operating results for the full year 2024, they had an operating loss of over 1.3 million euros. This is a big improvement from 2023, when the loss was over 5.3 million euros. This reduction in losses in 2024 seems to be due to lower administrative costs, partly because executives and directors agreed to waive their salaries until the company is listed. This is great for short-term cost cutting, but it is not sustainable long-term. In fact, they expect costs to rise significantly once they are a public company and have to pay their executives and deal with all the new requirements. Their cash flow from operating activities is tiny, just 4,385 euros for the 6 months ending the 30th of June 2025. This is mainly from advances from related parties, meaning their CEO is still funding the company. They are still very pre-revenue and rely on their CEO's financial backing. A massive chunk of their assets, 65 million euros, is in intangible assets. This is primarily their intellectual property, their patents and technology for these home tests. This shows where their value is focused, on the technology they've developed. The company believes it can continue to operate for at least the next 12 months, largely due to the financial support from their CEO and an expected big license deal. This is reassuring, but it also highlights their heavy reliance on these two sources for survival. Their core strategy hinges on their intellectual property. They are betting big on their patents and unique technology being a strong competitive advantage. They are actively seeking to protect these through patents and other legal means. Let's look at a specific intangible asset. BreastCheck IP rights are valued at 60 million euros. This is the company's flagship product and a massive part of their intangible asset value. For investors, it is important to know about taxes. In Ireland, there is generally no stamp duty on issuing shares, but a transfer might have a 1% duty unless it is on a regulated market. Like Nasdaq, for us investors, the tax situation is more complex, especially if the company is considered a passive foreign investment company or PFE, which can lead to special and often unfavorable tax rules. This explains how shares can be sold after the listing. Most shares will be freely tradable, but those held by company insiders called affiliates will have some restrictions for a period, like volume limits. Registered shareholders may sell their ordinary shares through broker-dealers, at prevailing market prices, in block trades, in ordinary brokerage transactions, in negotiated transactions, or in any manner permitted by law. This reiterates that it is up to the individual shareholders to decide when and how to sell their shares. Revere Securities LIC is playing a key role as their advisor and market maker. They'll be helping with the listing process and making sure the market runs smoothly once trading starts, but crucially, they won't be acting as underwriters to support the price. The designated market maker, or DMM, whose job is to help maintain an orderly market, has very specific limitations. They can't set or influence the reference price or the opening auction price. Nasdaq handles the auction itself. Revere's responsibilities are broad, covering advice, helping with the prospectus, talking to investors, and providing quotes once trading begins. They will also work with Nasdaq on the opening auction. To try and make the initial trading period a bit more stable, many shareholders holding more than 999 shares have voluntarily agreed to limit how many shares they sell each day for the first 180 days. This is meant to prevent a flood of shares hitting the market all at once. However, it is voluntary, not everyone signed up, and the company can't enforce it. To wrap up the direct listing process, the most important takeaway is that the DMM's role is limited. They are there to help with technical aspects and maintain an orderly market, but they cannot influence the price or provide any stabilization support. This means investors should be prepared for potential volatility. Now, let's put on our Warren Buffett hat and look at the bigger picture here. Davion Healthcare has a clear vision with their non-invasive home tests, and the market for early health detection is definitely growing. Their strategy of licensing is smart for capital efficiency, but it introduces significant partner risk financially. They are burning cash. And that is typical for a company in their stage of development, heavily investing in R&D and intellectual property. The 65 million euro intangible asset value really shows their bet on the future success of their technology. However, the material weakness in financial controls is a red flag that needs careful attention and remediation. It suggests that their internal processes for reporting and managing finances aren't as robust as they need to be, especially as they prepare to be a public company. The reliance on the CEO's personal funding and the waived salaries for executives is a double-edged sword, while it keeps costs down now. It is not a sustainable long-term solution, and the cost of living will likely increase significantly once they are a public company. The direct listing itself presents a unique set of risks, primarily related to price volatility and market stability due to the absence of traditional underwriting mechanisms. The company's future success hinges on their ability to execute their licensing agreements, particularly the Big New York deal, and for their products to gain market acceptance. If their partners deliver and the products resonate with consumers, they could see significant growth. However, the risks are substantial, from regulatory hurdles to partner performance and the inherent volatility of a direct listing. It is a high risk, potentially high reward scenario. They've got innovative technology and identified a market need, but they need to prove they can navigate the complexities of commercialization, manage their finances effectively, and overcome the challenges of being a newly public company. We'll be watching closely to see if they can turn their strong IP into a profitable business. Alright, that is our deep dive into Davion Healthcare's latest filing. What is your take on their direct listing strategy and the risks involved? Let me know your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and make sure you subscribe for more breakdowns like this. And don't forget to join our Discord community, the link is in the description. And see you next time on Corporate Decoder.